Okay, now we're in Chapter 2, Part 2. I have some problems that I want to do together. This first one is going to be one that I'm going to do the problem, and then you have a version of this problem assigned in your homework. So definitely pay special attention to this first one because you're going to do one very similar. And there's one thing in here that can seem a little bit confusing. So with this problem, Sally and Charles received a 1099 dividend and distribution form. And I'm going to go ahead. So this is number 20. Number 20. In the back of your book, I'm just going to do this on the Cengage site because it's a lot easier than trying to do it on Word because I need the forms to fill out. So here in this problem, here's the 1099 dividend form. You can see the amount of dividends that are considered qualifying, the information for the taxpayer. Also, we have other forms that aren't shown, but they're giving us the information for them. So we're going to be using that information. So let's go ahead and fill in this interest in ordinary dividends tax form. Okay, so the name shown on the return, that's already filled in there for us. The Social Security number. So we need to list first interest. So this is the interest section up here. And then down here is the dividends section. So for interest, where did our interest come from? Let's go back up here. We know that the interest amounts aren't on here because they only told us about dividends, so we're not worried about that right now. But interest. So for interest, we received money from these two different banks. And we also have Charles got interest from some New York bonds. We know that that interest is tax deductible, or sorry, not tax deductible. I used the wrong word. Excluded from gross income. So this $100 here, we don't have to do anything with, but we do need to do something with these other two interest amounts. So first we have interest from Porcine, I guess, Bank. That is $1,245. And then there was some interest from River Bank. That is $650. Add the amounts, $1,895. Subtract line 3 from line 2. Nothing to show there. $1,895. Okay, so just remember you're not doing anything with this $100 in interest that Charles received because they are City of New York bonds. Something that's excluded from taxable income like that doesn't need to be shown on the return at all. Okay, now we need to list our dividends. So we had some dividends from Altus. They were $2,000. Also some dividends from Buller, $350. Also from Gene Corporation. So you can see some of these tax forms first look like a little bit scary, but whenever you're filling in a tax form on Cengage, it gives you the boxes you need to fill out, and then it's really not that scary. It actually becomes kind of fun because you go, oh my gosh, I'm filling out tax forms, and it's kind of exciting. Okay, we have all of our dividends shown, so let's go back up and look at the dividends, make sure we got all of them. We have all of those amounts. We have the $2,000, we have the $350, we have the $3,100, and the $850 that came from this form right here. So don't forget that when you do this problem on your own. This qualified dividends amount, we don't need to do anything with that on the form. The $694 is included in the $850. So it's not an additional dividend amount. It's just information saying that these are qualified dividends. But that's not a topic that we're covering right now. But know that the $694 is already included in the $850. So you're not doing anything with the $694. Okay, we need a total. And We're done. Cool. That was an easy problem. So you're going to do one just like that on your own. Okay, let's take a look at, now I want to look at number 21. So here, Vandel is a taxpayer in the 25% tax bracket. He invests in Otay Mesa Water District bonds that pay 4.5% interest. What interest on a taxable bond would provide the same after-tax return to Vandal? So because these Otay Mesa Water District bonds, because these are government bonds, the interest is not taxable. So this question is saying if you invested in a taxable bond, what would it need to pay in order for you to net 4.5%? Because if you invest in a taxable bond, you're going to have to pay tax. So you can look this up in your book if you don't remember, but if you go back to Learning Objective 2.10, you're going to see the formula that I'm going to show you. So we take the 4.5%, which is the tax-free interest rate that we want to arrive at, and we want to divide that by 100% minus 25%. And why is it minus 25%? Because Vandal is in the 25% tax bracket. So he pays 25% on his taxable income. Okay, and what does that give us? That gives us 6%. So the reason why I wanted to do this problem is because you need to know how to do this when you do number 22 in your homework. So hopefully you're watching all these videos before you do your homework, because it probably makes it a lot easier. Okay, let's look at number 24. So here, number 24, now we're talking about gifts. And there's definitely a few different things to keep in mind with gifts. We have to make sure that there's gifts that are just gifts, like I gave my brother some money because he's family, or gifts that really are payment for services. Because people can be try to get smart and try to figure out how they can exclude things from taxable income. And the IRS has already thought of all those really common things, so they make sure and include it in the tax code. Okay, Gwen is the tax accountant who works very hard for a large corporate client. The client is pleased and gives her a gift of $10,000 at year end. So we might just think, okay, I remember that gifts were excluded from taxable income up to whatever the amount is for that year. The amount, they'll change it every year or every couple years. It continues to go up. Hopefully it never goes down. But in this case, the $10,000 is going to be taxable. So don't just look at the word gift. Also, consider here that this is clearly a bonus. It's in a business setting coming from a client to somebody that's doing work. So even though they're calling it a gift, it's still a payment for services and needs to be included in gross income. Okay, number 28. Arlene is required by his 2018 divorce agreement to pay alimony of $2,000 a month and child support of $2,000 a month to his ex-wife Jane. What is the tax treatment of these two payments for Arlene? What is the tax treatment of these two payments for Jane? So in 2018, this changes after 2018, but we're just learning 2018 tax rules in this class. Tax rules sometimes will change every year. They'll change when a new tax law is passed, and then sometimes small little laws will be passed where something will expire at the end of 1 year or be effective in 1 year. So 2018, what we're focused on here. So Arlene is the one that paid the alimony. Arlene is able to deduct the $2,000 a month on his tax return. He does not get to deduct child support. Child support is never deductible. And then Jane's the one receiving the alimony. Jane has to include that in her taxable income. Child support has never been taxable, and I'm sure never will be. So there's the answer to that one. What's interesting about this one, and this isn't what we're covering in this course, but it's just kind of interesting to see how sometimes tax laws change. Like we just talked about, in 2018, Arlene was able to deduct the $2,000 a month in alimony from his gross income. And then Jane had to include it in her gross income. That changed as of the end of 2018. Now in 2019 and going forward until it changes again, alimony is just not handled at all. So Arlene does not get to deduct it anymore on his tax return in 2019. And Jane also does not have to include it in her income going forward. So kind of interesting. One of the things that's kind of interesting and creates a lot of work related to someone being a tax professional is there's a lot of continuing ed and keeping up on all the changing laws that you have to do. That's one of the reasons why people are kind of scared of tax work and they're willing to pay someone else to do their tax return for them. So if all this stuff seems kind of fun to you and you think you might want to be a tax person, go for it. Because there's a lot of people that don't want to do their tax returns and it just makes them uncomfortable. One of the reasons that makes everybody so uncomfortable is, number one, the government kind of likes to give us this feeling that we should be afraid of the IRS because, oh my gosh, we might get audited and they might come and ruin our lives. In actuality, that doesn't really happen most of the time. But also because these laws are just changing all the time and it's a lot of work to try to keep up on all of it. Okay, so something interesting about that one. Now let's look at number 31. Jose paid the following amounts for his son to attend Big State University in 2017. And then we want to know how much of the above is a qualified higher education expense for the purposes of his qualified tuition program. Okay, so tuition, definitely included. That's kind of the most obvious one. Room and board, definitely included. So let me type that out here. 6,000 plus 4,775. And then also the books. The books are definitely included. So plus 772. What do we think about a car to use at school? I'm thinking no, right? The answer to that one is no. Student football tickets, definitely no. And then also spending money, definitely no. So the total here would be $11,947. So tuition, room and board, books, fees that have to be paid to the school. So, you know, all of us that are taking classes at Normandale, they charge us tuition and then they charge us all those fees. Those are included also. Okay, one last one. Number 34. Okay, so the last one, number 34, we're going to look at each of these three situations and then determine the taxability of Social Security. Before I started learning anything about accounting or learning anything about tax, I just kind of, you know, we all have all these assumptions that we make in our mind about what we think might be taxable and what we think is not taxable. Before I started learning, I thought that Social Security was just not taxable, but it is in certain circumstances. So something to keep in mind when you're planning your own retirement planning. Some other benefit that we get from taking this class, right? There's going to be so many little pieces of information we get to take that are useful for us. So it's so cool. Okay, a 68-year-old taxpayer has $20,000 in Social Security income and $100,000 in tax-free municipal bond income. So you will remember when you look at the Social Security worksheet that has to be filled out in order to determine taxable Social Security, and you actually are going to fill out one of those in number 33 in your homework. The $100,000 does have to be looked at and included in adjusted gross income in that formula that you have to work through to determine the amount of taxable Social Security. So again, that form is on page 33, or sorry, not page 33, number 33 in your problems, and it's also in your book. So everything's not just a real simple, quick answer. Sometimes you have to fill out the form, but we definitely include the $100,000 in filling out the form. Number 2, we also have a 68-year-old taxpayer, has only $20,000 in Social Security income. And is that going to be taxable? The answer is no, because a single taxpayer can get up to $25,000 in Social Security income in 2018, or $32,000 if you're married filing jointly. So number 2 is none of it is included. Number 3, we have this taxpayer with $20,000 in Social Security income. He also has, or she also has, significant other taxable retirement income. So distributions from a 401k, an IRA, potentially things like that. What is the maximum percentage of Social Security that the taxpayer might be required to include in taxable income? And that amount is 85%. And you'll even see that 85% calculation as you go through that taxable Social Security worksheet. But that's the answer to number 3, 85%. Okay, I am done with Chapter 2, Part 2.